Hi, everybody, and welcome to our third quarterly investor call of 2023, and thank you for joining us today. This call is being recorded and will be available for replay by visiting our website, clicking on the Resources tab, and then clicking on Quarterly Investor Call. Before we get started, we must remind you that the purpose of today's call is educational, and the material presented is publicly available information from sources believed to be reliable. The information in this presentation may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice or recommendations to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. Please visit our website or our YouTube channel to view the recording of this call or any previous calls. Justin's going to start off our presentation today, so I'm going to turn it over to him.
Thank you, Carly. Well, good afternoon, everyone. We're just working on getting the camera set up here. And thank you to those of you who are attending today. The live presentation will be recorded, and thank you for all of you who are tuning into the replay. There we go. So today you'll see Dominic and I are presenting. Peter is also here to participate for the Q&A segment of the call. Just in the interest of time, we only have one of our research team members talk during the prepared remarks section of the call. However, if you have a question specific for either Peter or Dominic, they are both here and available to answer those questions. I have prepared some macroeconomic perspective and commentary about our thoughts on the market today, and then Dominic is going to have the floor for most of the call to discuss our sales and purchases over the last 18 months and the thought process about what we buy and sell. And then finally, we'll address any questions at the end of the call. You are welcome to type those questions into the chat box at any time, and we will just respond to those in the order that they are received. So before we get started on the economic and market updates portion of the call, I think this is an opportune time to provide our clients and new listeners with some of the foundational principles that are really the backbone to our investment policy here at O'Keefe Stevens. And first is that we are long-term, goal-focused, and planning-driven owners of diverse portfolios of successful companies. And we aim to buy these companies at what we believe to be discounted prices. So put simply, we seek to align with quality businesses and then act continuously on our plan as opposed to reacting to current events and to market conditions. And this year has provided a compelling example as to why we are convinced that the economy cannot be consistently forecasted and nor the market consistently timed. So I had a call recently with a gentleman who had pulled roughly $2 million of his portfolio out of the market at the end of 2022 after a year of losses. And he believed that the United States was going into a recession because of everything he had been reading. And today he's convinced that that recession is still coming, but he's upset that he missed out on the 15% returns that were achieved during the first half of the year. People who've been swayed by the narrative of financial journalism over the last year and a half are now questioning whether their decision to get out of the market was a wise one. And I cannot imagine how nerve-wracking the decision about when to get back in would be, since prices have run up and recession concerns are still here. And the situation we're in today reminds me of a quote from famous investor Peter Lynch, who said, "The real key to making money in stocks is to not get scared out of them." And our feeling is that your best chance to capture something close to the full long-term return of stocks is to ride out those frequent and sometimes significant, but historically always temporary declines. And more often than not, the equity markets prevail against the backdrop of economic, political, social uncertainty. And these apocalypse du jours, as we like to call them here, They always seem to carry great weight in the moment, but they tend to fade into obscurity and are eventually replaced by the next fear fad. And our policy has been and will continue to be just to stay the course and to act only when your plans change, not at the whims of the market or the economy. And it's these principles that continue to be the bedrock convictions that inform our investment policy as we're pursuing your financial goals together. So with that said, I'll turn to the updates on current markets and macroeconomic data that we find relevant today. After declining sharply for most of 2022, the S&P 500 ended the year at 3,840. At the start of 2023, it seemed as if the economy might be in a no-win situation. Either the Federal Reserve would tighten credit conditions enough to stamp out inflation, thereby pushing our economy into a recession, or it would relent, avoiding the recession, but permitting inflation to carry on. And in either case, we were assured that corporate earnings must be about to decline significantly, boding ill for the stock market. And we'll add to this the problematic situation about what the Fed would do, all the unforeseen challenges we endured during the first half of 2023, which are detailed in this neat little chart compiled by the folks over at JP Morgan. Let me zoom in here. Some of the headlines that jump out at us include, in the first half of the year, the US government hits its legal $31.4 trillion debt limit. The one-year mark of the war in the Ukraine. Silvergate Bank voluntarily liquidates. Silicon Valley Bank fails. Signature Bank fails. Credit default spreads spike. US government suspends the debt ceiling. New York City covered in smoke. The list goes on and on. Yet, after enduring that relentless onslaught of different crises, both real and imagined, the S&P 500 closed out the first half of 2023 at 4,450, up 15.9%. And there's a lot to be said here, but instead, I'm just going to repeat Peter Lynch's timeless advice. The real key to making money in stocks is not to get scared out of them. In that sense, these 6 months represent for me, and I hope for you listening, a successful investing career in a microcosm. You and I did all that we can be asked of us amid this universal pessimism, in that we didn't get scared out of our portfolio. And by staying focused on our goals and on our long-term plan, with confidence that the management of the companies we own were taking good care of our capital with diligence while they sought out new and potentially greater opportunities amid that adversity. In summary, everything that happened and everything that didn't happen in the first half of 2023 turned out not to matter that much. What mattered was that together we chose not to react. And it is possible that a lifetime of patient, disciplined investment success is just that simple. And I certainly believe that it can be, and I hope that you do too. So zoom back into this halftime report. I should have done that before I read the last slide there. But to tie things together here, I have an old but still very relevant clip of Jamie Dimon, the CEO of the largest bank in the world, discussing the positive attributes here in the United States today. So I'm just going to play that quickly.
We have all the food, water, and energy we will ever need. Okay, we have the best military on the planet, and we will for as long as we have the best economy. And if you're liberal, listen closely to me in that one. Okay, because the Chinese would love to have our economy. We have the best universities on the planet. They're great ones elsewhere, but these are the best. We still educate, most of the kids who start businesses around the world. We have a rule of law, which is exceptional. If you don't believe me, you can talk about Britain, Brazil, Russia, India, Venezuela, Argentina, China, India. Believe me, it's not quite there. We have a magnificent work ethic. We have innovation from the core of our bones. You can ask anyone in this room where you can be more productive. Ask for sits in this factory floors who do it. It's not just the Steve Jobs, it's the George Death. We're the widest, deepest financial markets the world's ever seen. Okay, and I just made a list of these things. Maybe I missed something. It's extraordinary. It's extraordinary. And we have it today. Yes, we have problem.
So I think it might have been a little hard to hear, but I can email out the link to that clip. It's Jamie Dimon, the Economic Club of Washington, on September 12th. He outlines some important advantages, and I think it's important for us not to overlook these big advantages and the runway that they afford us as investors. If we look back over the last 100 years, the American experience has been one of steady but not always linear improvement. The lifestyle and amenities every person listening to this call enjoy today would top the lifestyle and amenities enjoyed by the wealthiest 1% 100 years ago. And our world is just full of amazing and sorry, the lights went out on me. Our world is filled with innovation and improvements across every industry, which lead to longer, healthier, and wealthier lives for an increasing percentage of the population, both here and abroad. So when it comes to investing, optimism is the only realism. If you believe the future will be better than the past, there is no place more logical to allocate your hard-earned capital than into the great businesses in America that drive this experience that we've all lived for our entire lives. And of course, there's no guarantee this will continue, and it certainly won't be evenly distributed across every company or every person for that matter. But as Warren Buffett pointed out to us many times in his writings, it's never been smart to bet against America. We believe this will hold true in the future, and we continue to invest in businesses that stand to benefit from this list of competitive advantages that we have here in the United States. So over the last year and a half, I think the faith of all long-term investors might have been severely tested, and this has to happen every few years. All we're basically required to do is just one big thing, and that's to reject the idea that this time it's different. If we keep the belief that this too shall pass, we'll be all right. But we must not doubt that we'll get many additional opportunities to practice our patience and discipline in the years to come, because with successful investing, although it's fundamentally simple, it will never be easy. So I'd encourage you, if you're listening to this call, you might have a family member, a colleague, a friend who perhaps did not fare as well during the 2022 bear market, and who you feel might have benefited from this sort of advice that you've been receiving. And should that be the case, I certainly would appreciate your introduction to them. It would be very enjoyable to work with them as it is with you. We welcome these opportunities to offer the same level of service, planning, and care to the people who you care about. So with that, thank you for being our clients and for your engagement on these calls. With that, I'm going to pass things over to Dominic for a full update on the activity of our portfolios over the last 18 months. Dominic?
Perfect. Thank you, Justin. As Justin pointed out, the last year and a half has been a volatile one. From January 1st, 2022 to July 30th, 2022, the Dow was down roughly 10%, S&P down 14%, and the NASDAQ was down roughly 21.5%. Since then, the Dow is up 5%, S&P up 8%, and NASDAQ up 16%. One thing we are not is market timers. Did we know the market would go up after July 30th? Of course not. However, when we can buy stocks on sale, the probability of generating satisfactory returns over the long run increases. When the market and our portfolio decline, it gives us the opportunity to take action. We could deploy cash if there is some available, or we could sell positions and rotate into higher conviction ideas. When others sell on short-term news and fears, we use that to our advantage. If we compare the companies we sold at the bottom of the timeline to those we purchased, shown on the top, there's a stark contrast in business quality. Tidewater and Devon are both in the energy space and are commodity-type businesses. They perform well when oil prices are high and poorly when they are low. These companies have little to no control over the rates or prices they charge for their service. It's all about the economics of supply and demand. When we think of a high-quality company, we think of a business with a competitive position in its industry, pricing power, and a defensible business. In the case of Tidewater and Devon, they operate capital-intensive businesses in a challenging cyclical industry. In general, these are not businesses that we would like to own forever. You can do incredibly well if you catch the cycle at the right time. You just have to know when to get out. Seritage, while not a commodity business, had a very challenging business model, transforming old Sears locations into new premier shopping centers or other commercial real estate sites such as offices or apartments. This work involves working with local governments, banks, developers, and potential tenants. On the surface, transforming a site from retail to an office or apartment seems relatively straightforward. However, doing this over 100 properties in dozens of states with different government regulations and timelines and rising interest rates made this challenging. One of the exciting projects I did with students while teaching at Nazareth College involved valuing every single asset Seritage owned. At the time, the stock was trading around $7 to $8, and we came up with a value of roughly $10 per share, reiterating why we sold the position after the run-up to $11 to $12. Conversely, our purchases are far better businesses, which we happily own for the next decade. Outside of GreenFirst, a commodity lumber company, the remaining are all high-quality businesses with competitively advantaged products and services. The market and industries these companies operate in are growing. They have healthy and improving margins, can reinvest in the business, and have high-quality management teams leading the way. When given the opportunity, we prefer to own these high-quality businesses over time, as they should be able to grow revenues, earnings, and intrinsic value per share. The portfolio is of much higher quality given these changes. The exciting part for us is when we can purchase these companies when the market is pricing them as low-quality assets. High quality plus low price is an excellent setup over the long term. So we'll talk about each individual security that we purchased over the past 18 months. Donnelley provides regulatory and compliance solutions to the investment industry and companies looking to go public and other capital markets activities such as mergers and acquisitions, equity, and debt raises. The company is undergoing a business transformation from a legacy print business to a higher margin software and service business. Management laid out targets to grow this software business double digits over the next several years. Given the management team's track record of delivering on its goals, and the aggressive share repurchases, we have a high degree of confidence this will be a larger and better company over the coming years. While our base case is the stock is trading around 10 times 2024 earnings, we can also envision a scenario where they generate over $6 in earnings, putting the valuation potentially at 7 to 8 times earnings. Donnelley has the potential to be a classic Davis double play, where the company grows earnings and the market gives the stock a higher valuation. For instance, Donnelley should generate around $4 in earnings this year, and the market is currently valuing them around 11 times earnings. So if we take the $4 in earnings, multiply it by the 11 price to earnings ratio, we get the stock price of roughly $44. What if our scenario in 2024 plays out, and instead of the market valuing it at 11 times earnings, it realizes how good of a business it is and says they will now pay 15 times earnings. resulting in a $90 stock. If you take the $6 in earnings, multiply it by the 15 times multiple, you get roughly a $90 share price. The combination of growing earnings and multiple expansion is very powerful. DFIN continues to be one of my favorite investments. It's a high quality business, a great management team, and an attractive valuation. While GreenFirst's business is a Canadian lumber producer, other assets made this a differentiated bet relative to a pure lumber producer like Weyerhaeuser. For instance, they own 118 acres of prime real estate in Kenora, Ontario, some of which is located on the water. They recently signed an LOI for 30 of the 118 acres for $8 million. The good part is this was some of the less desirable land as it was not on the water. They also own the Boreal Forest, which was 203,000 acres of timberland, which they sold for $49 million, which allowed them to significantly reduce their debt load. One headwind Canadian lumber producers face is they pay duties on exports to the US. The company's current duty rate is roughly 21%. So if they sell a piece of lumber for, say, $100 to a US company, they must pay $21 to the US government to do so. In August, this duty rate will decline to 8.2%, which is a dramatic reduction in fees they will pay. Since 2021, they paid a total of $85 million in duties. And they, along with other Canadian producers, are in a legal battle with the US government to recover some of this cash. So I want to take this moment and read a passage from Paul Rabette. He's the current chairman and CEO of GreenFirst. And I want to read a passage from his chairman letter. It says, quote, in 2022, our cumulative deposits were $77 million. The last softwood lumber dispute with the United States was settled in 2006, resulting in a refund of $5 billion, equating to an 81% return of deposits back to Canadian lumber companies. The settlement expired in late 2015. Since 2016, total Canadian lumber industry deposits now exceed $7 billion, the most on record. Given this extreme level of trapped capital, we fully expect a historically similar resolution and release of capital at some point in the future. So, if the company received 80% of the $85 million in duties on deposit, they would receive almost $70 million of cash back, which is roughly 45% of the company's current market cap. In addition to this, they have an overfunded pension with a 27% funding surplus and several other monetizable assets. And this is all before you get to the core operations of the lumber mills we own. While thus far, the stock has been a poor performer since we put the position on, it's probably the investment I am most excited to talk about. Next up is Lazard. Lazard is one of the world's leading advisors on mergers, acquisitions, divestitures, and related strategic matters. They also have one of the most well-respected asset management businesses in the industry with over $230 billion of assets under management. One of the main reasons we like Lazard is because of the dichotomy of the two business segments. During periods of economic strength, the stock market is likely rising, leading to higher assets under management, and higher assets under management equates to higher revenues and earnings. While the asset management business is doing well, the company's advisory and restructuring business is unlikely to be performing great because few companies need bankruptcy and restructuring services during good years. On the other hand, during periods of weak economic environment, the market is likely weaker, leading to lower assets, which lowers revenues and earnings. However, the advisory and restructuring business is likely performing well. This business segment has incredible margins, showing the power of the Lazard name, which allows them to charge higher prices. First Republic, the California bank that recently failed, hired Lazard during its challenging time to help them explore options. Lazard is most likely a company's first choice when challenges arise. You can see how this give and take relationship should perform well over time. It's a business that generates a lot of cash, has little need to reinvest, and can afford to pay a solid quarterly or solid yearly dividend. With little concern, they will need to cut it because whether it's a good time or a bad time, one of their segments should be performing well. One interesting event occurred during the quarter when reports of Abu Dhabi's sovereign wealth fund holding talks with former Lazard CEO Ken Jacobs to take it private. Talks ended, but it could be something monitor to watch going forward. Home builders, timber REITs, and others estimate the housing market is anywhere from 3 million to 5 million units underbuilt. This shortage is the result of the aftermath of the global financial crisis in 2008 and 2009, where the following decade experienced housing production well below levels needed to sustain population growth, household formations, and obsolescence. It is estimated that close to 40% of the current housing stock is older than 50 years, 50. Either repairs will become ever increasing or houses will get torn down and rebuilt. This tailwind should benefit TriPoint. When we initially purchased TriPoint, they had a tangible book value of roughly $2.5 billion. This reflects $3.5 billion in real estate they own, less the $1 billion of debt the company had. So if we take the $3.5 billion, subtract the $1 billion of debt, that gets us to our tangible book value of $2.5 billion. The market capitalization at the time was roughly $1.9 billion, which meant the market did not believe the assets the company owned were worth what they were stated for on the balance sheet. Therefore, TriPoint traded at roughly 0.67 or 2/3 of price to book value. Typically, buying a home builder at less than 1x book value has been a successful strategy in normal times, and less than 0.8x has been a successful strategy in times of stress and uncertainty, as long as there's not widespread impairments like we saw in 2008, 2009. The company typically traded between 1x and 1.5x book value. And again, it was trading at 0.67. So we could purchase the company at close to half its long run valuation. What's remarkable is TriPoint has compounded this book value at almost 17% per year since 2013, which is very impressive. Over the long run, our returns should mirror the rate at which book value per share grows at. Next up is BGC. So while BGC is a relatively new investment, the thesis for why we purchased it continues to play out. The company continues to transition clients from its legacy phone-to-phone business to its higher margin electronic business. This is very similar to what I discussed for Donnelley, going from a low margin to a high margin business. You may have seen a transaction on your statement when BGC Partners converted from a partnership to a C Corp. In the process, changing their ticker symbol from BGCP to BGC. Nothing changed on our end with regards to ownership stake or voting. The conversion simplifies the reporting structure. The conversion also allows for BGC to get included in indexes such as the Russell 2000. Companies operating under a partnership are ineligible for Russell indexes. When indexes are required to buy the stock, they do not care what the price is. They are just required to purchase it. This event typically results in a significant stock price increase. Further, BGC's overall business is improving due to the significant rise in interest rates and subsequent volatility. Over the past year, the US 10-year Treasury was as low as 2.58% and as high as 4.3%. The more rates fluctuate, the more trading speculation and hedging occurs. The market, in our opinion, is dramatically underappreciating the potential earnings this company can generate as it's been almost 15 years since interest rates were higher than 1 or 2%. Now on the last company is our most recent purchase of Sphere Entertainment. Sphere is located in Las Vegas, Nevada, and it will be the greatest entertainment venue in the world when it opens up in September. You may have seen this on social media lately as the lit up LED exterior displayed incredible pictures and videos. After several delays and cost overruns, the venue is finally going to open. Since the venue is not open yet, the business economics and results are highly uncertain. Will customers pay for higher concert tickets for this unique experience? Will companies advertise on the LED exterior? Will a corporation pay for the naming rights of the venue? A lot of uncertainty, very few answers. Vegas is becoming more popular with the Vegas Golden Knights, Las Vegas Raiders, and soon the Oakland Athletics. The Sphere cost roughly $2.4 billion to build. We were able to purchase it at almost half the cost, almost $1.2 billion. We believe the market is putting this company in the doghouse due to delays, costs, and a lack of disclosures, all creating heightened uncertainty. It's during times like this that we are able to purchase valuable assets for a fraction of the cost. So what brings all these companies together that I just talked about? There is one glaring and obvious correlation. The largest company I just discussed was Tri Pointe Homes, and that was a $3.1 billion company. And when we made our initial purchase, it was just under a $2 billion market cap. This chart shows the current market cap of all the companies I discussed compared to the median market cap of the S&P 500. As you can see, these are much smaller companies. So the question is, why are we investing much more in these smaller companies? So these two charts paint a picture of why we are finding more opportunities in the smaller names relative to larger ones. The right chart shows that small caps are the cheapest they have ever been since 2003 compared to large capitalization stocks, while the left hand shows small caps are the cheapest they've been since the valuation was tracked in 2003. Typically, small and large cap stocks trade at a similar valuation, shown by the 102.6% average on the left-hand chart. This chart uses the company's enterprise value, which factors in the company's debt load, and divides it by the company's EBIT, or the earnings before interest and taxes. It's a very popular valuation metric. Typically, companies with high EV to EBITs are considered expensive, while low EV to EBIT is cheap. The 102.6% means small caps typically trade at a 2.6% premium relative to large caps on average. However, you can see they currently trade at a 23% discount. When we see this kind of diversion from the norm, we must take a look under the hood and examine what is happening. The right-hand chart paints a similar picture. This time it uses the price to earnings ratio. This is the cheapest small caps have been relative to large caps using this valuation metric since 2000. While we do not know when this reverses, we know more ideas are likely to be found in smaller names. We believe the portfolio is well positioned should the valuations of small caps and large caps revert to historical norms. With that, we will now open up to questions, and I will turn the call back to Carly.
All right, thanks, Dom. Now we're going to move into the question and answer portion of the call. We did receive one question ahead of time, and that was regarding the transition of client accounts to Charles Schwab. So Justin, can you start with that?
Sure, thanks, Carly. So you all have probably begun receiving notifications in email form and in the mail about the upcoming transition. For those of you who are on the TD Ameritrade platform over to Charles Schwab, that transition is set to happen over the Labor Day weekend, and on Tuesday, September 5th, there will no longer be access to the TD Ameritrade accounts, and everything will be mapped over to Charles Schwab. The good news here is that this will not involve a whole lot of steps on your behalf to make those changes. Our team is here to guide you as you receive the instructions from TD Ameritrade and Charles Schwab on how to get set up over there. In the month of August, you will receive a mailing from TD. So whether you get your documents electronically or via paper mail. This will come via paper mail, so it should alert you to the process to go to the Schwab website, create a username and a password. We are here to support you to do that, but it does have to be done on your own. And one thing to keep in mind is if you have not been into your TD Ameritrade account in quite some time, you probably want to go in there and log in just to alert Schwab that you are an active electronic document user. And that'll trigger them to reach out with those instructions to get you set up. Otherwise, everything will revert to paper format. If you are a paper only person, there's nothing you need to do. This will happen automatically during the month of September, and your new statements will come from Charles Schwab. I would anticipate come tax time, there'll be some more questions, and we certainly will keep you updated on that. I would imagine that the 1099s will have to address the issue of receiving 1099s, given that you've spent part of the year at one custodian and part at another. But again, there will be lots of communication around that and plenty of support provided here from our team. So I hope that answers the question.
All right, thanks, Justin. We did get another question, and this is regarding NVIDIA. The client said it's had a historic rise in the last 6 months. Is there still upside with their market dominance in artificial intelligence? And will you be looking to sell a portion of the portfolio? Also, do you have a comment on their investment in ARM, who they wanted to buy but were denied by the FTC?
Sure. It was a historic quarter for NVIDIA, with the Wall Street being dramatically surprised when they announced earnings in May, and the stock had a one-day rise of 187 billion, which was the third highest in the history of the stock market. And then followed by that on June 13th, NVIDIA's market capitalization, or the value of all its stocks, rose above the 1 trillion mark, which is the 7th U.S. company to reach that goal. If we go back to our original purchase back in April of 2013, we were buying a company that was unloved and unwanted for a number of reasons. It was down 68% from its high value, and they were in incredibly strong financial shape, and they were a gaming company. In about 2015, that changed, and we also continued to purchase. The stock had then risen from $12.50 to $20 per share, and it's had a rise somewhere in the 130 times. And so, as a deep discount value investor, I'm in uncharted territories, and we think it's highly overvalued. But I'm also trying to be a responsible steward with your wealth. And how do we reduce our position from an investment management standpoint? It represents about 25% of our assets, which is far larger than virtually any other investment advisor in the country would ever allow a position to grow. So our approach on it is from 4 different standpoints. Number one is to sell some of our positions, which we have been doing. Another is to gift some of those outstanding gains. Others are through donations. And then also an area which many of you have been in touch with me about is issuing stock options that would allow us to earn some income and potentially reduce our position on the stock as well. So we're approaching them from a number of standpoints. Literally, we have such an incredible diversity of people's opinion on this. Everything from the fact that it's significantly overvalued, which is, we would agree with that, to other people are out there thinking the AI is in its very early stages and that it's incredibly undervalued. So we're just trying to read and learn about it and act accordingly for everyone's different situation that they have. Dominic or Justin, would you like to add to that?
The other thing I'll add to that is, the valuation and the future performance of the business is going to be highly dependent on the competition environment that they face. So if they're able to continue to be the market leader in their respective fields, data centers, artificial intelligence, there's a chance that, the stock is undervalued. But, as we saw with other companies such as Intel that dominated, in 2000 to 2010, once you start losing that technology competitive advantage, and other industry competitors are there to eat your lunch. So if we just think about it probabilistically, there's a much higher chance that competitors start to take away market share in the future, which would likely present NVIDIA being overvalued, as Pete said.
I'd like to add, I didn't answer the question fully because also we were asked about ARM in there. ARM is one of the world's greatest companies for helping companies design semiconductors, and they're the clear leader. That is owned by a Japanese company, and who had purchased that for about 32 billion and was willing to sell that to NVIDIA. But the many companies who have, it would create a potential conflict of interest in the minds of many companies that work with ARM to make their own semiconductors. So with that complaining by those in the regulatory bodies around the world decided not to. It was a very, very expensive transaction, and for a $1.9 billion company in terms of revenues. So we were initially against paying that kind of a price for it. But they did not ask our opinion when ultimately they declined on that. But it did cost NVIDIA $2 billion to when that merger fell apart.
I have nothing to add. Okay, Carly.
All right. Yep, we did get another question about the transition to Schwab. And that was, do clients lose all their historical statements, or will they be available for some period of time? I don't know if we have an answer on this at the moment. So we're going to look into that and get back to you, but I'm not sure that Schwab has provided that information on historical statements for the TD accounts yet.
I defer to the operations team to answer that question, and it is a very good question. Thank you, and we will be sure to address that in our communications, but don't have an answer right now.
Over my 43-year career, almost never does anyone ask for back statements. However, they are very interested in what their cost basis is. And clearly that cost basis information that we have will continue.
Correct.
Right.
All right. Any other questions, Carly, or we'll stick around for a couple minutes?
Yeah, we can stick around for a couple minutes. If anybody else has any questions, just type them into the chat or the Q&A and I'll take a look. We'll stick around for a couple more minutes here. I did get an answer. Marissa just let me know that historical statements and all documents will map over to Schwab from TD Ameritrade. So it looks like Kristen provided me with some information as well on the amount of documents that will come over. So there are 4 years of account history, 10 years of statements, 7 years of tax documents, 2 years of trade confirmations. So all of that information will still be available on Schwab's online platform from the TD transition.
Thanks for the quick action on that, Marissa. And Kristen.
Where's high fives?
Thank you for the high five from the attendee who just sent it. We appreciate it.
I don't see any more questions coming in. No one's typing into the chat or there's nothing in the Q&A. So we can end this call for today. And as a reminder, you can send in any questions you'd like answered by our team via email prior to these calls. And you can email any member of our team with your questions. We'll be sure to address them. And thanks again for tuning into our commentary on the market and your investments. You'll be able to replay a recording of this call within 24 hours on our website or our YouTube page.
Thanks, everybody.